Good evening. You're tuned into Business Day right here on ET Now with me, Deveshwar. And let's take a look as to how the markets panned out this Thursday before we take you through the top headlines. A disappointing session where you had an extremely aggressive sell-off in the broader markets. Benchmarks thankfully was spared that awful carnage. The market breadth was absolutely abysmal, 1:5 in favor of the declines. Very high volume activity, close to 2.3 lakh shares, and we managed to hold on to 6,000 by the day's close. But, of course, it was the broader markets which really saw quite a bit of selling pressure, 3% off almost for the mid in the small cap index. For the Sensex, it was 19,933, and for the Nifty, we held on to 6,000 by the skin of our teeth at about 6,019. Well, we get you all of the top stories of this hour after the headlines.
You have coffee, you have tea, right? Royalty goes out. So you carry on. Toothpaste you use, toothbrushes you use, shaving creams you use, royalty goes out.
ITC Chairman Vice Deveshwar hits out at Hindustan Unilever's move to hike royalty payout to its Anglo-Dutch parent. In an exclusive chat with ET Now, Deveshwar says such moves are bad for investors and will reflect very poorly on India. Just a day after Finance Minister P. Chidambaram promises foreign investors more leeway in debt markets, the government hikes the FII ceiling in both government and corporate bonds by $5 billion each. The government may trim short-term capital gains tax on equities. Sources, however, tell ET Now that the Finance Ministry is also mulling a marginal increase in securities transaction tax to make up for the loss of revenue. India's largest engineering and construction company, L&T, shows early signs of revival. The order book remains strong in the third quarter, with profits higher by 13% in line with estimates. The company says it's well on course to meet 84,000 crore rupees in terms of its target for new contracts. Tata Motors takes a beating after the company issues a profit warning for its British subsidiary Jaguar Land Rover due to currency volatility and rising costs. The stock tanks as much as 10% during the day before closing lower by 6%. NHDIL plummets over 23% in trade as investors dump the stock, fearing a further sale of pledged shares amid an alleged cash crunch. The management, however, reiterates that rumors of bankruptcy and defaults are false. Those were the top headlines at this hour. And like we've been telling you, the story in the market action today was purely in the mid-cap universe, especially some of the high beta counters from the infra basket, which cracked majorly in the session today. HDIL being a case in point, but apart from that, you had the likes of an IVRCL, a GMR, a GVK, all which really was smashed, coupled with very strong volume activity as well. Let's get an Ajay Sharma, who now joins us from our research team with more details on the same. A bloodbath, so to speak, for the broader markets, Ajay.
Well, that's correct. You can look at the trading pattern. It was peculiar in the sense that the Nifty did not really crack a whole lot, but it was the broader market, which entails the mid-cap index and the small-cap index, which sold off quite a lot, especially in the last 45 minutes of trade. Some market participants say that it was seen coming because the breadth was extremely weak past 1 week. Only select stocks were keeping the index above the 60-50 mark or even the 6,000 mark, but it was the broader markets were not really participating. So in that sense, it was seen coming. Today's sell-off, however, got triggered by pledge share concerns and also some other negative news surrounding stocks like IVRCL. But the trigger definitely came because the nature of the stock which got sold off. Look at HDIL, IVRCL, Punj Lloyd, Hexaware, Syntex. So the promoters, where there is a general perception that the financial capability of the company is on the weaker side, there is the pledge shareholding out of the overall promoter shareholding is very high. Those were hit hardest. Surely there is a group of traders who took advantage of that, but one cannot go on by saying that it was the unwinding of the beta trade which was happening. Reliance Communications, Suzlon, all these IFCI stocks which are categorized as beta trade sold off in the last half hour of trade. Traders also quite surprised that the market selling off, broader market selling off quite a lot, despite very positive commentary from the finance minister, who's on a 4-nation roadshow, and also that Nifty went into a discount after a very long time this time round. However, opinion still remains that by 31st of January, when this series expires, there could be some amount of short covering, which may actually start coming and take markets back to upwards of 60-50 levels. But most of the traders believe that there could be a little more weakness on the downside before a stage could be set for possible pre-budget rally in the month of February.
Thanks very much, Ajay, for giving us all of those details and really putting that entire sell-off that we witnessed today into perspective. Meantime, for the broader markets, as pointed out, it was a sell-off with the benchmark indices fairly stable in the session, given that the fall wasn't half as bad as what you witnessed for the broader markets. So you had the market breadth, which continued to remain in favor of the losing side, but we did hold on to 6,000, and by the end of the day, it was an exceedingly high turnover of close to 2.3 lakh crores. In terms of what happened with the sectoral movers, well, it was real estate all the way, which was smashed in the session 5% off or 4% off by the day's close, auto too following suit. What managed to hold up, though, was the FMCG basket as well as capital goods counters. Some of the big index losers today, Jaiprakash Associates stumbled in the session. You also had GAIL India as well as Tata Motors, which was a big laggard. Remember, in intraday trade, it slipped by close to 10% but managed to recover. Some stocks in focus then today in terms of results. You had Vijaya Bank, which put out its numbers. A fairly awful set of that. You had the profits, which were up by close to 2.4% at 127 crore rupees. Net interest income was also higher, but it was largely the asset quality which was a bit disappointing. This time around, it did stabilize, so 2.9% for the gross NPAs vis-a-vis 3.1%. It was the net NPAs which came in at 1.7% versus 1.9%, but the stock was down by 3% by the day's close. Sorry about that. Andhra Bank also put out its numbers and it ended down by close to 7%, close to the lowest point of the day. This time the profits were down by close to 15% to 257 crore rupees. Net interest income was down by 1.3% to 971 crores. And here's where the asset quality really took a beating. 3.8% in terms of the gross NPAs, net NPAs also coming in higher. The stock clearly not taking that information well. GAIL India, that one was down in the session as the proposed gas hike price is going to be a negative for the company as it buys gas from ONGC Oil India for its petchem business, and the counter, after starting off in the green, was down in the trade by and ended lower by 4.5%. Reliance Communications, not a great set of numbers. The profits were at 105 crores, revenues at 5,301 crore rupees. That's higher by just about 1.9%. But moving away from that, Exide Industries. Exide Industries also was down and out in the session. But in the meantime, let's take it straight to the stock of L&T, which put out its numbers today. Darshan is here with the details.
Well, clearly, Avan, on the financial side, L&T didn't surprise the street. It was rather muted. On the revenue front, we were expecting a growth of 15%. The growth came in at just 5%. Margins also, even if you impact for the Forex and the MTM, clearly that one not surprising, and the bottom line was mainly driven on the back of higher other income. Segmentally also, it was just the engineering and construction which saw revenue growth. Apart from it, the other two divisions were pretty much weak, but margin improvement was seen in most of the other aspects also. But the main reason why L&T grew was the fact that the order inflow, which is very, very closely formed, closely seen by the markets, was very, very high. 19,500 crores of order inflow when the market was anticipating close to 15,000 crores. So clearly that was a big positive. The other positive is the fact that the management commentary, they have indicated that, even though the market is very, very tough at this point of time, they see the order inflow, the order guidance of 80,000 to 84,000 crores being met, and they expect orders of 20,000 to 25,000 crores coming in the next quarter. So clearly, and quarter 4 is always strong for L&T. So on the back of the orders that came in, showing robust trend there, the markets are rewarding L&T.
At the beginning of the year, we projected a 15 to 20% growth in the order inflow, and last year, if you recall, we closed the year with about 70,000 crores worth of orders. So by translating these percentage growths,
we had given an indication of anywhere between 80,000 crores to 84,000 crores during the current year. Notwithstanding the skepticism around these projections that has existed through the quarters, we have reached about 75% of the way. We are at 60,000 crores, looking at 20 to 25,000 crores for quarter 4.
For the reviews we have done, there is a good healthy order pipeline in this quarter, both domestically and international.
Okay, that's the latest on L&T. Meantime, Tata Motors took a beating in trade. It slid as much as 10% after the management said that the margins of the JLR models are set to shrink. What has made the management turn bearish about the margins? Let's get in Yatin Mota, who joins in for more on that. Yatin.
Well, Avan, as you rightly mentioned, Tata Motors stock was at the lowest levels in December 13, and why not? We had the JLR provisional results which came in as well as the management commentary, wherein they clearly mentioned that the revenues visibility for the quarter gone by will be a bit higher versus the previous quarters, but if you talk about the margins, that will be lower on a quarter-on-quarter basis, and that was concerning to the analyst community because most of them anticipated a stable set of margins for JLR rather than a decline coming in. The management clearly indicated that because of the adverse sales mix, because of higher Evoque sales, which is basically a low margin product for JLR, and because of the adverse currency movements, the margins will not be as good as the previous quarters, and some bit of decline is anticipated going forward as well. And that is the core reason why, the Tata Motors stocks saw some bit of sell-off. If we talk about the brokerage's view, nobody has cut the target price on the street. Some of the brokerages have been slightly reducing it, but not a cut coming in as far as most of the brokerages are concerned. No downgrades also coming in. Most of the brokerages, including CLSA as well as Citi, advise their clients to buy on any kind of weakness, and Tata Motors stock should be bought in from a long-term perspective. However, there are some short-term bottlenecks which will be resolved with the management going forward. If we talk about Morgan Stanley also, they remained negative in the short term, but going forward, given the fact that the company has been raising funds via bond issue, as well as the capital expenditure will be on the higher side, the long-term perspective for Jaguar Land Rover remains quite healthy, and that is why any kind of weakness in Tata Motors stock should be bought into. Most of the brokerages have been constructive on the JLR front, but of course, given the fact that the margins have been cut, which accounts to almost 95% of Tata Motors consolidated earnings, there was some rub-off effect. But given the fact that the stock has bounced back, clearly indicates that investors from the long side have been buying the stock at lower levels.
Okay, thanks very much, Yatin, for joining in and putting that into perspective. But of course, the big story for the day, HDIL, that counter plummeted in the session by close to 23%, recording the highest ever volumes as investors dumped the stock, fearing further sale of pledged shares after a partial stake sale by the Vice Chairman and Managing Director Sarang Vadhavan amid an alleged cash crunch. The management, however, today in a conference call asserted that the rumors of bankruptcy and defaults are completely false.
Promoters are not looking to sell any further shares in the company to fund any kind of land transaction. They're very comfortable in our debt repayment schedule, and it's as per the schedule. A lot of our residential projects are nearing completion. The cash flows have improved considerably as compared to last 6 months, and at least 3 of our projects are on the verge of completion, which itself will result in approximately 200 to 250 crores of inflow in next 3 months' time. The promoters have given assured to the board of the directors of the company that there will not be any further sale of shares by the promoters henceforth.
Okay, but the management commentary did not even allay the investor concerns. And we also learned from SEBI sources that the market regulator is keeping a close watch on the HDIL script. Let's get in Vijay Iyer, who joins us with more details. Vijay.
SEBI indeed is keeping a close watch on how HDL stock has behaved, particularly in the last 3 days, getting hammered by close to 40%. SEBI is going to seek the trade data pattern from the stock exchanges of HDIL, and also indeed see what was the bulk transactions that happened in the stock. Also, SEBI is going to ask for some tough questions to be answered by HDIL management, particularly when it comes to the promoter share being pledged, which stands to the extent of 98%. So yes, SEBI is keeping a close watch, and the management of HDIL will have to do answering for some tough questions by the regulator in the coming weeks ahead. But indeed, SEBI doesn't want to create any more panic, as we all know how the stock has behaved. but nevertheless SEBI has taken note of how things have panned out on HDIL script, and indeed the market regulator will get into action mode very soon in the coming week as far as HDIL goes.
Okay, thanks very much, Vijay, for giving us those details. The finance minister is trying to go all out to woo foreign investors. In a move likely to hike foreign money into India, the government has raised the foreign participation limits for both the government securities and corporate bonds. Anirudh Ghosh now joins in with the details. Anirudh.
Certainly, this move is going to increase foreign participation in the debt market. Of course, both corporate and government security debt limits have been raised. And of course, what we're picking up is that there is a huge foreign interest in both of these markets. Of course, given the kind of rate differential, it's only obvious that foreign money will be looking for quality paper that's offering high rates. Of course, you look at the GSEC yield at close to 8%. It's much higher than those in the developed markets. You look at corporate bond paper, of course, that's offering a higher rate than the GSECs as well. So clearly, it's no surprise that foreign investors are really knocking on the doors of the Indian debt market at this point of time. And of course, this is going to be a big positive for both the bond market. We're going to see yields coming down over there, and of course, the more dollars that come in are going to, of course, increase the sentiment for the rupee, and we're expecting this to be a positive for the rupee and the rupee to gain over the next week or so, of course, after the markets reopen from Monday onwards.
Many thanks, Anirudh, for giving us all of those details. And in a move to attract more investors into the equity markets, the Finance Ministry is also weighing proposals to reduce the short-term capital gains tax applicable on listed securities. But at the same time, North Block is also mulling a marginal increase in the securities transaction tax to make up for the loss of revenue if STCG is lowered. Suchetna Rena joins in with the exclusive details. Suchetna, what are you picking up?
Sources in Finance Ministry tell us that the Ministry is seriously considering a proposal to cut the short-term capital gains tax on listed securities to 10% from the present rate of 15%. But obviously this will hit the revenue. The government collects about 3,000 crore rupees from the STCG, and to offset this loss, the Finance Ministry is also considering a marginal hike in the securities transaction tax. This tax ranges from between 0.025% to 0.1%, and a marginal hike in that will boost the government's revenues, because the government is collecting about 5,500 crore to 6,000 crore rupees from STT this financial year. And sources tell us that given that the daily transaction volumes have shot up in the past few months, a marginal hike in STT will definitely set the exchequer ringing for the government. Now, the cut in short-term capital gains will be applicable to both domestic and foreign investors. Definitely a move to lure investors into the equity market. This is also, so experts tell us, this could be another way of offsetting the negativity that GAR will bring on FIIs who operate out of Mauritius.
Okay, thanks very much, Suchetna, for bringing us those exclusive details. Time for some big voices then from the World Economic Forum at Davos. ITC Chairman YC Deveshwar has slammed Hindustan Unilever's decision to hike royalty payment to its parent company Unilever. Speaking exclusively to ET Now's Supriya Srinath, Deveshwar says that such moves are bad for investors and will only reflect poorly on India as an investment destination.
The moment a child is born, the diaper that is used, the royalty goes out.
Yes.
Right? The baby food that you have, the royalty goes out. The shampoo and soap that the babies generally use,
yes.
People who can afford,
right.
The royalty goes out. The water that we drink, the royalty goes out.
Yes.
Right? You sit at the breakfast table, you have cereal, you have coffee, you have tea, right? The royalty goes out. So you carry on. Toothpaste you use, toothbrushes you use, shaving creams you use, the royalty goes out. So pizza you have, or your hamburger you have, the royalty goes out. So you name anything, there are very few Indian brands. So I can tell you that I'm sensitive about this, because our country will not hold its head high unless we have our own intellectual property. We have our own R&D, and we have our own brands. Some of the companies, 30% of their profit
That's right.
was going as royalty. So it is not only the small shareholder.
I have a quick question to ask you without taking names. Certain people in the hotel industry have been very wary of what ITC could do to them. Should a certain Mr. Oberoi continue to be worried?
Not at all. Not at all.
No hostile takeovers happening there?
How can it be? How can it be? If I had 44% of any company, no hostility would ever
Occur there.
get anybody there.
One last question.
And I've always said, see, this problem is nobody wants to believe it.
I'll believe you. Give me an answer.
Yeah, the answer is it was a treasury operation, right? And
it was never an intention to
have a takeover bid or a hostile bid.
Right.
But yes, after we acquired a significant part, right, we did think that there could be enormous synergy which would benefit both organizations. But for that, both must comprehend it the same way.
There had to be meetings of mind.
Meetings of mind, but that didn't take place. So
what stopped from the meeting of minds?
I don't know. I'm not in somebody else's mind.
You would have been keen, so obviously
Yeah, I'm always keen.
Well, you can catch the entire interview with YC Deveshwar, Chairman ITC, in Davos Direct at 7:30 p.m. this evening. Stand out right here on Business Day. Thanks so much for watching. Keep it with ET Now.